Hey everybody, Dave here, Hidden Freedom. Welcome back to another video. In this video, I want to talk about stocks versus rental property. Okay, so this is a video that I've been wanting to do for quite some time. It also got requested recently for me to do this video. I do have experience with stocks for over roughly about 20 years, and I also have experience with rental property for about 9 years roughly, so a better part of a decade there. So I do have a good perspective of both. You hear a lot, just, I don't know, through the grapevine, I guess. Robert Kiyosaki is a good example. Carlton Sheets, if you're a real old school person. You got, what's that guy, Grant Cardone. I mean, you got a lot of characters out there that just really, they're pro real estate, okay? And I also see it on Twitter all the time. People on there just looking for property and saying this, my rental that, blah, blah, blah. So, look, there's a bunch of different ways to skin this cat, okay? So what we're gonna do is dig in this video. We're gonna talk about the pros and the cons, the ones I could come up with anyway. And then, I'm gonna give you some live examples, not live examples, I'm gonna give you a real world example from my property. And then I'm also going to pretty much just compare the results of both, right? Pros and cons, and also, the returns and all that stuff is just an example. This video is not really to persuade you either way. I just want you to be informed, and I want you to make a good decision there. Doesn't mean you can't do both either, okay? You can do one or the other, you can do both, it doesn't matter. But anyways, it's not wasting time because the video could get long, so let's go ahead and get started. The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. All right, well, like I said, on Twitter, I see a lot of people pretty much talking in there, like that's the way to go. Got to get into rentals, Been pounded from all these celebrities and, people that made a fortune and stuff. And they made a lot of money through real estate. And you can, but it's not the only way to go. And a lot of it, honestly, I feel like people think it's the only way they can go, and they're scared of stocks, so they go the real estate route, and that probably would work for them in general. In most cases, it would probably work for them, but, it's going to be location dependent, in my opinion. Some parts of the country, it's just not going to work out very well, in my opinion. Yeah, it might keep up with inflation, but you'd be doing better off in the stock market. So, I've heard arguments that saying, it's a tangible investment. That's the reason why I like to be in it. And I just don't agree with that. I just don't agree with it. So let's talk about the house pros and get through these pros and cons here. And then I'll talk about the live examples. So house pros, right? Let's just say, and these are just in random order, all right? They're not like prioritized or anything like that. It's just what I came up with at the top of my head, all right? So house pros, leverage, right? Leverage is a good one. And that's a pretty good, good safe bet there, right? Let's just use a $500,000 property. You're gonna put roughly about $100,000 in that property, 20%. And so you're leveraged $400,000, right, off the bank. And that's, the reason why real estate is so good, because you're leveraged at a pretty low rate. I guess recently it's 2.8 to 3 something percent. So that's pretty darn good, right? You're leveraging $400,000. You only had to put $100,000 in. And, but that also comes with a con as well, which we'll get to. So, the second thing is House Pro is is positive passive income. Okay, now it's passive, but it's not passive. It still requires work. It's not 100% passive, and I don't care. I've talked about this in another video, 2 years ago. Even if you have a manager, it's still not passive 100%. You still need to be involved. And if you think you're not going to be involved, then what you're doing is you're costing yourself money, okay? Because if you're going to let the managers try to handle everything, they're going to nickel and dime you. They're going to miss things on the walkthrough, inspection, and all that stuff. They don't have your interest at heart. The only person that really has your interest at heart is you. So it's not 100% passive. Just know that, all right? So another house pro is appreciation. In general, I'd say you're going to keep up with the inflation at minimum probably. And then some areas, if you're in a really good metro, is that right? Metro location, I'm in Denver, okay? If you're in, parts of California, parts of Washington State, parts of New York, parts of wherever, some parts are going to appreciate more than others. Some places could appreciate 20%, 30% a year. It just depends, okay? But in general, I'd say throughout the whole country, you should at least keep up with inflation. So that brings us to tax preferable / deductions. In general, houses are pretty tax preferable. You can deduct, a lot of expenses, repairs and all that. I guess you really can't deduct improvements to the property, but you can space those out over several years depending on what type of capital improvement the property's had. So tax preferable, yeah. You can deduct things, and then we're talking about HOA, we're talking about property tax, we're talking about interest, we're talking about the management fee, and whatever repairs that you've done, right? So repairs, don't always think when you're doing a rental property, never replace, always repair. Always try to repair if you can, because those are deductible right off the top of the income, versus trying to spread it out over 5 to 7 years. In some cases, it might even be longer than that. Depreciation is what it's called. So there are some tax benefits to that. That also brings us to defer and depreciation recapture. Yes, you can do that. Right now, there's something called a 1031 exchange. So you're in the house for, X amount of years, and you can divide that out by 27 and a half years, which is the usable, life of that property per se. And then what you do is you deduct that every year, and that comes off the income as well. And there's a way to get out of the property still and not have to pay the depreciation recapture. And it's called a 1031 exchange, which means you're going to have, I think, 6 months, if I'm not mistaken, to find another property to roll over these gains into, basically. So you're going to sell your house, and then you find another property, and then you get in that property, and guess what? You don't have to pay the depreciation recapture. So that's kind of a good thing. They're talking about even getting rid of the 1031 exchange. And so the only bad part is, which is probably house cons, I haven't got there yet, is there's no long-term solution to get out of that, So you pretty much have to take them to the grave. All right, that brings us to house cons. So one con is it's not liquid, okay? You can't get your money out fast. If you had an emergency or something like that, you need to get all your capital out. Guess what? You're not gonna be able to get out, and guess what? You're gonna have to pay long-term capital gains, assuming you're in for at least a year. You're gonna have to pay depreciation recapture if you don't do a 1031 exchange. And you're gonna have to pay a commission fee to sell the house, which could be, 6% or something like that. I know it cost me upwards, I think, $60,000 to sell my house with the depreciation recapture and the long-term capital gains and the commission as well. So it's not cheap to get rid of a house, right? And it brings us down here to location dependent. Okay, so house cons. Yes, if you're living in Podoke Town, you might not have a good opportunity there for rental properties. Okay, the rental properties might be cheap, but they might not appreciate as much. They might not bring as much rent. They might have low income people that trash your house. So it's gonna be location dependent, in my opinion. Right? In Denver, I had no problems renting that property, right? No missed payments, nothing like that. Over 9 years that I rented that property out. The other property was in a different state. 0 missed payments in that state, on that property either. But it didn't appreciate as good as the property here, and the rent didn't really go up because I didn't raise it up because I didn't want, it really, here was a stronger rental property market here, and we're talking about from 2010 to 2011. One of them was in 2010, one was in 2011, all the way to 2018 and all the way to 2019. So that was during the recession, the financial crisis. And I got lucky enough here that I was able to rent it out, and I took a small loss on it every month for about a year or two, and then finally it caught up, and then I started making money on that property. That brings us to high barrier to entry, okay? So houses do have a higher barrier to entry. $500,000 house, $100,000 down. And because it's a rental property, they might have other requirements as well as having a certain amount of cash in your account to cover missed payments and stuff like that. I know there's other programs out there, first-time homeowners and all that. There's programs out there for first-time homeowners, but honestly, those aren't really for people that are going to rent the property out. So, but there's still programs out there for people that want to buy a second property as well as an investment property. But in general, there's going to be a little bit more stricter requirements on that. Now, you probably still have to put 20% down. In some cases, it could be less. I know one of the properties that I had done was only 5% down, and it was in 2011, so the house price was low anyway, and I could still make the numbers work. The other property is a house that I bought, and then I turned into a rental about 4 years after I had bought it. Okay, so yes, higher barrier to entry. All right, second, another one here is potential unknowns, damages, bad market, fire, or whatever, right? So there's unknowns with rental property. You could have a tenant that just decides to take all of the copper out of the house and just leave. You could have a tenant that hides stuff and tries to repair stuff on their own and then tries to blame it on the previous tenants. They try to blame it on that something just broke, and they could be liable for it, right? I had a tenant that said the microwave door just fell off when they're eating, just literally fell off. And I know that wasn't the case because it was a brand new microwave, and the handle was actually glued on. I don't know who actually did that, if it was a previous tenant or whatever, so we know that somebody was probably hanging on that door at some point. So I think that they were liable for part of the microwave because microwave doors just don't fall off. I've been around a microwave since the 80s, and guess what? I've never seen a microwave door ever fall off. So, they can make a flood, right? They can flood the upstairs bathroom by overfilling the sink, overfilling the tub. It's happened to me here in this apartment twice now, that I've had water leak down and ruin stuff in my downstairs from the upstairs neighbor up there. And for one of my rental properties, which is a 2-story, 4-bedroom, 3.5 bath, I found out that somebody overflowed either a toilet or they overflowed a sink or bathtub. And they basically patched the ceiling and tried to hide it, tried to paint it and everything, and didn't find it until, I didn't find it because I wasn't there to do the inspection. I was working out of town. But my managers didn't find it either, right? So that's what I'm saying. The managers don't always catch everything either. So there's unknowns there, right? And that could be, they might just pay that month or something like that. They could move out. They might still live there and not pay their rent. You have to deal with that, right? You have to deal with an eviction process, which could take a long time. There could be in different parts of the country. There could be basically, a stay or eviction moratorium on evictions, and you could get screwed for a whole year or longer. What if you couldn't get rent, or you were getting rent, but you couldn't kick them out, but you still had to make your, $1,700 or $2,000 payment, right? You're gonna be liable for that, or you're gonna lose your house. And you can lose the down payment that you put down on the house. So there's a lot of unknowns there. House cons, so another one is it's not passive, which I kind of talked about already. You have to be involved. I'm sorry, the manager or not, you need to be involved somewhat. You need to at least prove those tenants, the new tenants. You need to talk about raising rent up. You need to really walk the property every time somebody moves out, because if they move in, let's just say they move out, you get everything trimmed, you get all of the hedges trimmed, you get the grass trimmed, you get all the weeds picked, whatever, and you need to take pictures of the whole house, take video of it and whatnot, and of the landscaping and whatnot. Those people will move in. I guarantee you, those tenants, when they move out, they're gonna say it was like that when they moved in, no matter what it was. There's two things you always hear from tenants. It was like that when I moved in, or the house looks better now than when I moved in. Those are the two things you always hear from tenants, okay? And they're both lies. The house is not gonna look better than when they moved in, okay? And you're gonna know it best, right? Because you're gonna take video and you're gonna walk around the house. So when they move out, guess what? Most likely they didn't trim all the bushes, they didn't cut all the weeds, they didn't trim all the weeds, they didn't trim the trees, they didn't trim the landscaping or anything like that if they're responsible for taking care of the landscaping. And then you're gonna have to charge, you know, $500 to $1,000 to have somebody come out and take care of all that stuff for you, because my property was pretty darn big, a bunch of trees died and whatnot. And it's hard to pinpoint that on them, but those are the two things you always hear. Trust me, you're always gonna hear that, right? Yes, that brings us to the cons, the end of the cons. So house pros, house cons. Let's go through some stocks pros here. So stock pros, low barrier to entry, right? That's a good one. I mean, you can buy fractional shares right now. You can get into Tesla, you can get into Apple, you can get into Facebook, you can get into Google, you can get into Microsoft, you can get into Amazon for fractions of a dollar. So it's a low cost of entry, low barrier to entry in stocks, okay? Yes, you can start with, you know, $5. There's no reason to wait around for $100,000 down payment to get invested. So you can get invested. You can get invested in your teens. You can get invested as an adolescent, growing up. You know, you take the trash out. You get paid an allowance. You can invest in stocks. Just have your parents open you a custodian account. Okay, brings us down here to another pro, and that's diversification. You can be diversified across a bunch of different sectors, 11 sectors, okay? So all of the popular 11 sectors out there, you're invested in. So there's diversification in there. And if we want to go wider than that, you can go across the whole world in different areas, geographic locations in the world. You can get into bonds, you can get into mutual funds, you can get into a bunch of different types of assets as well, right? If you're in real estate, guess what? You're really just in real estate. Okay, that brings us down here to taxes for stocks, and taxes, if they're long-term capital gains, is 15%. For most people, it's 15%. If you're actually a really high income, I'm $400,000 above or something like that, then it could be 20%. But in general, most people, it's going to be 15%. For capital gains, long-term capital gains, you have qualified dividends, it's still 15% for qualified dividends. If you're in short-term capital gains because you sold a stock for whatever reason and you got into another stock, then it's going to be whatever ordinary income bracket you fall into. And the same thing with unqualified dividends like REITs, for example. So those will be unqualified dividends, which should be taxed at your normal rate. Okay, another stock pro is it's liquid, right? You got a, you got a wedding coming up, and hopefully you don't drain your account for a wedding. But if you do, which you hope you don't, it's liquid. You can sell it. You can sell it right now if you want, right? Let's just say you wanted to go buy a rental property. You could take the money out and go buy the rental property, right? So it's liquid. And what you should be doing is draining out that wedding and putting the money into stocks. But who am I to judge? I think weddings are one of the worst things you can spend your money on. Spend your money on the actual honeymoon. You know, I'd rather spend $20,000 on a honeymoon than I would spend on the actual wedding itself. But that's just me. So, all right, another stock pro, appreciation and income / passive income. So yes, stocks will appreciate. Stocks can pay you passive income as well, either through dividends or through dividends. It really depends whether or not you want to go the dividend route, because if you say invested in VTI or VU, or an index fund like that or something like that, then yes, they do pay a dividend, but it's not a big dividend, okay? So you could go the dividend route. That works as well. You know, I have done videos on how to build a dividend portfolio. You can take a look at that video if you want. It's a pretty in-depth video, how to, basically start. I think it was a 2-part series, if I'm not mistaken. So yes, appreciation and income. All right, and then another pro here is it's passive, okay? So that's another good one. Stocks are passive. It's way more passive than a rental property, as you stick your money in there and you go in a coma for 20 or 30 years, you come back out of a coma and you're a millionaire. So, all right, yes, they're way more passive than a rental property is. Stock cons. Let's bring this to the stock cons. No deductions. All right. Obviously, you can open a LLC and have it treated like an S corp or something like that, and be a professional trader. And you can deduct some things, but in general, there's not as many deductions as there is a rental property, obviously. So that is a con, a little bit of a con there. Another possible con would be over trading, would be another good example. So you get into stock, you change your mind, you sell, you get into another stock, it goes down, you're like, oh, I don't like this, you sell, you get into another stock, you sell, and it's just a lot of emotions involved there. And that is not how you're going to outperform the market, nor are you going to outperform the rental property at that point. So that could be something, because it's so easy to get there and make a decision. And that's one thing about rental property, is once you're in it, you're pretty much fixed in it for a while. There's nothing that's really going to change. The payments are going to stay the same. The rental income is going to stay the same. Every year it might change a little bit, but in general, almost everything stays the same, right? So over trading could be a problem for people in stocks. They change their mind a lot, and that could cause them to lose money. Another stock con is possibly more volatile. And I would say it's most likely going to be more volatile than a rental property is going to be. A rental property is going to be a little bit more stable. It's not going to be, even if it was volatile, it's going to happen over a longer period of time, versus the stock market is probably going to end up happening over a shorter period of time, right? 1 month period, 2 month period, 6 month period, something like that. Even a couple week period is possible. So those are the pros and cons. Obviously, I probably even skipped some stuff here, but with a house, you got appreciation and you got income as well. So that's kind of comparable to stocks as well, right? If you went with a dividend portfolio, for example, you're gonna have appreciation plus you're gonna have dividends. So you have passive income plus you have appreciation there, right? And they're pretty comparable, to be honest with you. Use a $500,000 example as again here. So a $500,000 investment into a rental property. Let's just say you pay the rental property off, okay? And it brings in about $2,500 in income a month, but you have to subtract you got to subtract the property tax, you got to subtract the insurance, you got to subtract the HOA, you got CapEx in there, and whatever repairs in there as well. And I guarantee you're going to make about the same as you'd probably make in stocks passively. I would say about 4% or so, anywhere from 4 up to 10%, but 10% would be very tough to get, I think. Not everybody's gonna be able to get that. Looking at the property that I just sold, there's no way I could get above about 4% out of that property. And that's with everything paid off, okay? So in stocks, it's not that hard to get 3.5% out of a dividend portfolio. So you're gonna be right there with a lot less headaches, okay? So what I would say is, some people say, well, what about the passive income? Well, both pay a passive income. Matter of fact, I'd say the stocks are more passive than the rental property is, and they're pretty comparable. Unless you're in a really good area or you got a super good deal on that house and it's super cheap. I'm talking about the actual house, how much it's worth, okay? I'm not talking about if you put $100,000 down. I'm not talking about like a cash on cash return. I'm not talking about that at all. What I'm talking about is you paid the house off. It's $500,000. You want to retire. You have 3 properties. There's $1 million in there. It's going to be pretty comparable to what a stock market portfolio would pay you in passive income. So in the stock market portfolio, it's going to be more passive, obviously. So the last thing we're going to look at here is we're going to talk about just as a appreciation point of view. Okay, so my property I sold in August of 2019-ish. And I looked at the property, so I sold it for roughly about $380 or so. And that property is worth $530,000 now. A little over, let's see, that was 2 years later. And I'm like, I kicked myself in my ass because I just lost, a boatload of money. But so that's like a 28% return? That sounds pretty darn good for 2 years, right? I mean, that's way better than inflation, right? But, you know, what if I was in stocks since August of 2019 to now? So let's run that calculation. So what we're looking at here is we're looking at the ETF channel here, and we got August 2019 there to today, which is November 10th, 2021. We're just going to look at the SPY because that's the overall market in general. And we run those numbers there. We come out with, let me see if I can make this a little bit bigger here. Well, I'll probably zoom in, but so I'm not even gonna look at without the dividends and reinvested. I'm not gonna even count the dividends reinvested. So my property sold for what, for about 380 or so, and it's 580 now, 530 now. So my property, basically I sold for 380 and it's worth 530 now, which is roughly about a 29% basically capital gain or appreciation in a little longer than 2 years or so. Well, look at this. Here's SPY. Same time frame, 62.8% return you got out of the stock market. How can you tell me that real estate is better than stocks? Okay. I hear it all day long that, you know, real estate's better and than stocks. People are afraid of stocks. What about this? What about that? You know, look, the numbers don't lie, okay? So $500,000, vested over here with $500,000 vested over here, you're gonna do probably better in stocks over time. And in general, you know, Denver's not a really bad area, right? I mean, Denver's a pretty strong market. There might be other places in the country that could outperform the market, but 60%? I don't know of a lot of areas that are going to appreciate more than 30% a year. You know, California, you're lucky to get 20, 25%, and that's a good year. And that's good in the stock market as well, right? A 20% move in the stock market every year is a pretty darn good move, right? So that's just a good example. Denver, obviously, compared to the stock market here, I look back at those numbers and say, well, you know, I should have stayed in my real estate. I should have stayed in the rental, but you know what? I was invested in stocks, so I'm not really complaining about it. And the last thing I want to touch on here is people that probably invest in real estate are afraid of the market. They don't want to invest in the market because they're afraid of the market. But what I would say is, yeah, they're different asset classes, but I don't think you should have all your money in real estate either. And I would say if the stock market goes to zero and it has that big of a problem that it goes down 70% or goes to zero, most likely you're gonna have issues in your rental property anyway, to be frank with you. You're gonna either have missed payments, people not paying you at all, the house prices are gonna go down, people can't afford it, they're gonna lose their jobs, whatever. So I would say if the stock market goes to zero, your houses aren't worth crap anyway, because there's gonna be bigger issues going on in this world than money, and you better hope you got brass, you know, in your closet. So which one should you go with? Well, that's really up to you. I think a good combination of both is not a bad decision. I did it for quite a while. I'll probably never ever invest in real estate ever again in my entire life. It's just not passive enough for me. I don't want to deal with it. If I want to go live in some other country, I don't want to be dealing with, you know, properties that are here. You know, I mean, if you're local to a property, then more power to you. You're going to be able to save a little more money. It's going to be a little bit easier to manage. But you're going to probably have to take them to the grave. Otherwise, you're going to pay a boatload of money in capital gains and depreciation recapture. So I think for younger folks, it's not a bad way to go both ways. And, you know, maybe when you get a little bit older, to dump the properties and then finally go into more passive investments like stocks, for example. I'm not trying to deter you either way. I'm a little partial to stocks at this point because I've been through the real estate route. Honestly, a lot of it comes down to people. I do think that people like the prestige of owning rental property, right? The fact that they can say, I own 6 doors, you know, and it just sounds impressive, right? When you talk, I got to work on my rental properties this weekend, you know, like it sounds impressive, right? You know, I got stocks, you know, I got to work on my stocks this weekend. That doesn't sound impressive, right? So a lot of it comes down, I don't know how much comes down to that, but I think there's a little bit of a fascination with rental properties, thinking that they're in some sort of an elite club because of that. And honestly, they couldn't be more mistaken in my opinion. Once you get into it, you're going to find out it's not hard. It's nothing special about it at all. The reason why a lot of people go that route is because a lot of people don't know anything about investing, and guess what? Real estate's easy. It's nothing hard about it. The hardest part is finding the property. That's the hardest part. You're gonna make the money when you find your property, and that is literally the hardest part. So one of the best ways I would say, if I was gonna get back into real estate ever again, or I could basically make a recommendation for somebody starting out with real estate, is I would say do the BRRRR method. Okay, so that means buy, rehab, rent, refinance, repeat. Okay, now this is a term that I got out of Bigger Pockets. I used to be a member over at Bigger Pockets for quite a while. The BRRRR method, hands down, is the best method to get into real estate. And you're probably going to have a pretty good return doing the BRRRR method as well. I think that's what Our Rich Journey did. That's how they made quite a bit of money in a short amount of time. But in general, if you're just Tom, Dick, and Harry, and you go buy a property off the market, you're not going to make a pretty good return on that property right off the bat. So anyways, this video is kind of long. Let me know what you prefer. Do you like both? Do you want one or the other? Do you want rental property? Do you want stocks? And let me know the reason why down in the comments. So until next time, please go ahead and like and subscribe. We'll see you in the next video. Thanks for watching.